The repo rate is not a common term for the majority of people. However, this rate has a number of implications for the economy, people's finances, and lifestyle choices. In this video, we will discuss what the repo rate is and explain how this rate affects you and your finances. Welcome back to Public Administration 101. Proudly brought to you by Kano Consultants. For professional advice you can trust. As indicated, in this video, we discuss what the repo rate is and its impact on you and your finances. Without wasting any more time, let's get into today's video. As a starting point, let's explain what the repo rate is. The repo rate refers to the interest rate at which the central bank within a country lends money to commercial banks and other financial institutions. In order to make money, banks and other financial institutions would then lend out this money to businesses and the general public at a rate higher than the repo rate. This enables the banks and other financial institutions to make a profit. They generally quote their profit baseline as prime, which is repo plus profit. The prime rate is therefore the lowest rate of interest at which money may be borrowed commercially for someone with a good credit score. In some cases, the bank may offer someone an interest rate which is lower than prime. So, why do interest rates change? Interest rates are used by central banks to control the supply and demand for credit. If they want people to spend less money and tighten their belts, they would increase interest rates. Every country has its own monetary policy, which regulates when an interest rate can be changed. In South Africa, the South African Reserve Bank's Monetary Policy Committee meets every 2 months to decide whether to increase, reduce, or leave interest rates the same. Due to the fact that the South African monetary policy provides for an inflation of between 3 and 6%. Should the inflation goes above or beyond this prescribed range, then the South African Reserve Bank would then elect to adjust the repo rate accordingly. In other countries, interest rates are increased and even decreased for other reasons, such as making sure the country's currency is stable, as well as maintaining trust in the economy. One of the most recent examples of this can be evidenced during the height of the COVID-19 pandemic, where many governments dropped their repo rates substantially to save their economy from collapsing. In this next section, we will unpack how changes in interest rates affect the economy. But most importantly, how these changes affect you and your finances. But before we get into that, if you are new here, welcome to our YouTube channel. This is where we aim to clarify and simplify some of the aspects of public administration, public management, and public finance. So, make sure that you support the channel by clicking on the subscribe button. This is to make sure that you don't miss out when we post new videos. You can also support the channel by joining our exclusive membership community. Let me take this opportunity to thank and welcome our new members. And if you are interested in getting exclusive early access to our videos, please consider joining our community membership by clicking on the join icon below this video. Also check out this video to learn more about the role of the South African Reserve Bank. We will pin the link to this video in the comments section below. Now, let's get back to today's video and discuss how interest rates changes affect the economy. But most importantly, how these changes affect you and your finances. Let's start with the impact of higher interest rates on the economy. When interest rates are higher, loans become more costly, which means people abstain from borrowing. In this scenario, people who have opted for loans will have to sacrifice a huge portion of their income due to the high interest payments. Due to shortage of disposable income, people won't spend as much on goods and services. If they don't spend, there will be a shortage of liquidity in the market, thereby leading to a bearish economy. A surge in interest rates has a negative impact on both consumers and businesses. Due to a liquidity crisis, companies would not be able to roll out new investments and expand their products and services. Higher rates mean more foreign investments looking to capitalize on the higher interest rate. Therefore, a rise in the local currency that the investments must be converted to. Now, what is the impact of lower interest rates on the economy? A fall in interest rates makes loans more affordable and accessible. This would encourage people to opt for loans at marginal interest payments, which in turn mean an increase in disposable incomes. When the interest rates are lower, it is easier for people to buy assets, such as home or vehicles, through financing options. This triggers a rise in the prices of assets, and therefore an increase in wealth. Increase in disposable income due to lower interest rates may make consumers spend more money on goods and services. This will in turn lead to higher liquidity and eventually a better economy. Lower interest rates are less attractive to foreign investors, resulting in a lower relative currency value. Now, how does the repo rate affect your finances? In short, the higher the interest rate, the more you're going to spend on your loans and debts. The lower the interest rate, the less you're going to pay on your debts. Because the repo rate cannot be negotiated. It's worth negotiating the prime rate that your bank offers you. For over-indebted consumers, higher lending rates can mean that your monthly repayments are harder to meet. Consider future possible rate increases or decreases in your budget. A higher repo rate results in a higher savings return because of the rise in interest rates. Therefore, make sure you put the money you save away into a savings account. Sadly, if interest rates are low, the interest the banks pay is also affected. If you're living off the interest, you might need to start digging into your investment capital to survive. Property prices rise as the repo rate rises. This is because you do not have the same buying power as a lower repo rate. Try looking for a house that falls within your means. Before we conclude, please note that any information contained in this video or under our channel is not intended, nor does it constitute financial or other advice. Before making any decision or taking any action regarding your finances, it is recommended that you should consult a qualified financial advisor. In conclusion, understanding the repo rate and its effects will help you manage your finances more carefully, especially when it comes to taking out a loan. Keep in mind that interest rates increase and decrease with the repo rate, and you do not have control over that. You should therefore consider how much interest rates may increase when you take out a loan, and make sure you can afford any potential increases as a result of interest rates increases. For example, do not take a home loan with a repayment that you will struggle to afford at the current interest rate. Should the repo rate rise, and your repayments with it, you may find the repayments unaffordable. You should also ensure that you have a strong credit record and a good repayment history. If you ever get into any trouble repaying credit, rather negotiate with your credit provider than ignoring the problem. We've come to the end of this video on the repo rate and its impact on you and your finances. So, thank you for watching. Please take time to check out these other videos on public administration and public finance under our channel, where we discuss various topics relating to public administration and public management, as well as the management of the public sector, including the running of government. And don't forget to like this video and subscribe to our channel for more content. And remember to turn on the notification button on your phone to make sure that you don't miss out when we post new videos. You can also connect with us by following us on social media @ConsultKano. And continue the conversation by leaving us a comment or tagging us on social media using the hashtag #ConsultKano. Thank you again for watching. Join us again next time for another video. Until then, check out these other videos. Kano Consultants. For professional advice you can trust.